America is running on fumes. Household savings have collapsed to their lowest level in 17 years, while credit card debt has blown past $1.3 trillion for the first time in history. Auto delinquencies are rising faster than they did in 2007, and more than 60% of Americans now say they can't cover a $500 emergency. Retail spending is still hitting records, but unit sales are falling, foot traffic is weakening, and debt is doing the buying. The engine of the US economy isn't slowing, it's stalling. And when the consumer breaks, the entire system follows. The American consumer is not just a participant in the economy, the consumer is the economy. Nearly $18 trillion of annual economic activity depends on households buying groceries, filling gas tanks, paying insurance premiums, and keeping the lights on. When 70% of national output comes from everyday spending, even a mild slowdown becomes a structural threat. A 2% pullback in consumption may look small on paper, but it removes more than $250 billion from circulation. That kind of demand shock forces retailers, manufacturers, suppliers, and logistics networks to scale down simultaneously. This is the pressure point the country is now approaching. The spending engine that has powered decades of growth is losing momentum, and the signs are no longer subtle. Credit usage is rising, not because confidence is rising, but because liquidity is disappearing. Transactions are being preserved, but volume beneath the surface is slipping. Consumers are still swiping cards, but fewer goods are moving through stores and fewer services are being purchased. The economy is still generating numbers, but it is no longer generating strength. This dynamic creates a quiet but dangerous divergence. The headline economy appears stable, while the internal economy is weakening. GDP may hold for a moment, but its foundation, household consumption, is eroding in real time. When 70% of output strains, every sector tied to that spending begins to feel the drag. Wholesale orders shrink, inventory cycles tighten, freight volumes soften, corporate expansion plans pause. What begins as a household squeeze rapidly transforms into a national slowdown. This is why the early cracks matter. When the core of GDP begins to lose force, the country enters a phase where each month of weaker spending compounds the next. A shrinking consumer base means fewer transactions. Fewer transactions mean fewer jobs. Fewer jobs mean further contraction. Nothing collapses instantly. It unravels segment by segment until the illusion of stability snaps. The slowdown in consumption is not a footnote. It is the first alarm. And once the backbone of the economy bends, every system built on top of it starts to shake. What looks like strength on the surface is often the clearest sign of weakness underneath. Headlines claim Americans are spending at all-time highs, but the numbers are deceptive. A dollar today does not buy what it bought 3 years ago. When consumer prices have climbed nearly 19% since 2020, raw spending totals naturally rise even if households are purchasing fewer goods. A holiday season that shows $960 billion in spending can mask a collapse in real volume when the cost of basic items has surged across every category. This is why the so-called boom feels nothing like a boom. Unit sales in apparel, electronics, home goods, and toys have fallen even as total revenue grows. Retailers are ringing up larger dollar amounts while watching transactions shrink. The data reveals a country paying more and receiving less, a consumer economy that is inflating, not expanding. Discounts have become deeper, promotions more aggressive, and cart abandonment is climbing. These behaviors signal a population calculating every purchase, not celebrating newfound purchasing power. The fracture becomes clearer when examining the mechanics. A toy once priced at $20 now sits at $28 to $30. Meat cuts that cost $80 for a family gathering now exceed $110. Transportation, packaging, and supplier costs push everyday essentials upward, leaving households little choice but to stretch their budgets through higher-priced necessities. The record-spending narrative depends on totals, not truth. It counts inflated dollars but ignores the shrinking quantity behind them. This distortion matters because official spending data feeds into GDP calculations. When inflation lifts nominal totals, it creates the illusion of economic resilience while masking the deterioration of real demand. Policymakers see large numbers. Households feel the opposite. That gap widens every month, the cost structure remains elevated. The weakening of real consumption links directly to the strain already emerging in the broader economy. If the backbone of GDP is slowing, inflated spending only delays recognition of that slowdown. It does not reverse it. This inflation-driven mirage is not evidence of strength. It is proof that the system is running hotter than families can sustain. And once inflated dollars can no longer compensate for collapsing volume, the downturn becomes impossible to hide. As real purchasing power weakens and inflated spending disguises shrinking demand, another force fills the gap: debt. The modern American wallet is no longer built on income stability, but on borrowed liquidity. Credit card balances have surged past $1.3 trillion, the highest level ever recorded. Average interest rates now sit near 22%, transforming everyday purchases into long-term liabilities. Instead of cash flow supporting consumption, revolving debt has become the bridge between rising prices and stagnant earnings. This shift is not a temporary adjustment. It is a systemic transformation. Auto loans now exceed $1.6 trillion, with delinquency curves steepening across multiple states. Personal loan borrowing has expanded at double-digit rates, not for discretionary upgrades, but to patch shrinking budgets. Even buy now, pay later platforms once marketed as convenience tools are now functioning as the primary liquidity source for millions. A growing share of grocery bills, household essentials, and medical copays are being financed through installment plans that did not exist a decade ago. This is the clearest sign of economic strain. Debt is no longer a tool for opportunity, it is a tool for survival. When debt becomes the default currency, households lose resilience. Every swipe, every installment, every finance necessity widens the gap between what consumers can afford and what the economy requires them to spend. That gap becomes an invisible pressure chamber beneath the GDP surface. The numbers reveal the stress with startling clarity. More than 60% of consumers report running out of money before the next paycheck. Credit card utilization rates are climbing, balances are rolling over longer, and interest payments alone consume billions every month. As these obligations expand, fewer dollars remain available for real consumption, accelerating the slowdown already visible in unit sales and foot traffic. This new financial architecture directly connects to the weakening backbone of the economy. When spending relies on borrowed money, the system becomes increasingly fragile. Debt can inflate totals for a period, but it cannot generate sustainable demand. It only postpones the contraction and amplifies its severity. Debt-driven consumption is not a sign of resilience. It is the final stage before the cycle turns. And once the reliance on borrowed dollars reaches its breaking point, the illusion of stability collapses with it. As debt becomes the operating system of the American household, the one buffer that once absorbed shocks has nearly disappeared. The national savings rate has fallen to levels not seen in over 17 years, leaving tens of millions exposed to even minor disruptions. A country cannot sustain rising debt burdens and falling liquidity simultaneously without entering a phase of structural instability. Yet, that is exactly where the United States now stands. The depletion of savings is not a small statistical footnote. It is the moment when economic stress becomes irreversible. More than 37% of households report having less than $100 in reserve. Nearly 60% cannot cover a $500 emergency without borrowing. The pandemic-era cushion, once totaling nearly $2.3 trillion, is gone. What remains is a population forced to operate with no protective layer between daily expenses and financial failure. This disappearance of reserves is what transforms routine problems into economic triggers. A broken appliance, a medical bill, an unexpected insurance increase, costs that were once manageable now push families into delinquency or deeper borrowing. Without savings, every disruption ripples outward. Delinquent payments slow down consumption, strained budgets reduce discretionary buying, and the entire economy absorbs the shock as demand weakens further. The collapse of savings also reshapes household psychology. Consumers begin prioritizing essential bills with precision, redirecting money toward utilities, fuel, and insurance while reducing everything else. That shift aligns directly with the weakening transaction volume and declining discretionary categories already emerging in the retail data. What looks like cautious spending is, in reality, a form of economic triage. This erosion of the safety net links seamlessly to the broader pattern forming across the country. The backbone of the economy is straining. Inflation has distorted the meaning of record spending. Debt has filled the gaps left by stagnant income. And now, with savings evaporated, the last margin of stability has been erased. When a nation loses its financial cushion, it loses the ability to absorb shocks. Every month without reserves increases fragility across households, businesses, and financial institutions. The system becomes more sensitive, more reactive, and more vulnerable. And once the margin for error disappears, the next disruption, no matter how small, can set off the chain reaction already building beneath the surface. With savings depleted and debt carrying the weight of day-to-day survival, the next blow comes from the category no household can escape: essentials. The cost of merely existing in America has entered a phase of relentless escalation. Car insurance premiums have surged 20% to 40%, the fastest increase in decades. Utility bills in several regions are rising at double-digit rates, adding hundreds of unexpected dollars to monthly expenses. Grocery inflation remains stubborn, lifting core food categories by 25 to 35% compared to just a few years ago. These are not discretionary costs. They are unavoidable drains on shrinking paychecks. This is the moment when financial strain becomes structural collapse. Essentials operate like a vacuum. As their prices rise, they consume a larger share of the household budget, leaving nothing left to sustain the broader economy. A family earning $60,000 annually may now spend over $20,000 per year on housing alone, another $8,000 on food, several $1,000s on insurance, and the rest on utilities, transportation, and healthcare. These categories leave no bandwidth for the spending that traditionally fuels growth. The spiral intensifies because essentials do not respond to consumer fatigue. Households cannot cut back on electricity or stop buying groceries. When essential costs climb, discretionary activity collapses, not gradually but suddenly. This is why retailers, restaurants, entertainment providers, and service businesses are reporting weaker foot traffic, shorter transactions, and lower unit volumes. The consumer is not shifting preferences. The consumer is being forced to retreat. The price spiral also amplifies the fragility created by disappearing savings. When basic expenses rise while liquidity evaporates, even small fluctuations in essential categories can destabilize an entire household. A slight increase in insurance, a higher utility bill during a heat wave, or a spike in fuel prices can push millions deeper into delinquency or force them further into borrowing. This pressure aligns directly with the weakening backbone of the economy. The strain is no longer about wants versus needs. It is about needs overwhelming everything else. Essentials have become economic gravity, pulling families downward regardless of income bracket. And once the cost of survival consumes the middle class, the broader economy loses the very engine that once held it together. As essentials consume larger portions of household income, another quiet rupture begins forming beneath the surface, one that reshapes the labor market long before it appears in official reports. Employers have started pulling back, not through headline-grabbing layoffs, but through the subtle erosion of income streams. Overtime has been slashed across multiple industries. Hourly schedules are being trimmed by 3 to 8 hours per week, reducing monthly earnings by $400 to $900 for millions. Hiring freezes have spread through retail, logistics, healthcare administration, and technology, eliminating opportunities before they ever materialize. These are not random adjustments. They are early defensive measures taken by companies watching consumer demand weaken in real time. When unit sales fall, when foot traffic slows, when service volume declines, employers respond by reducing labor costs without triggering statistical alarms. Contractors are released quietly. Seasonal workers are never called back. Temporary roles expire without renewal. Performance reviews become exit mechanisms. Yet none of these cuts register meaningfully in the unemployment rate. On paper, the labor market looks stable. In households, paychecks are shrinking. This divergence creates a dangerous illusion. Economists cite job growth while families feel income compression. Government data reflects employment counts, not the erosion of hours, bonuses, benefits, and supplemental earnings. A worker who loses 20% of their hours is still counted as employed. A contractor whose contract is not renewed is not tallied as laid off. The gap between lived reality and reported statistics widens month after month, masking the early phase of labor deterioration. This weakening of employment ties directly into the broader economic strain already spreading across the country. When the cost of living rises while income quietly contracts, households lose the last resource needed to withstand higher essentials. Reduced wages accelerate the retreat from discretionary spending, deepening the slowdown forming across retail and services. The economy does not absorb these losses gradually, it absorbs them instantly, as millions experience smaller deposits and shrinking schedules. The silent job cuts are the connective thread between weakening consumption and the next economic phase. They represent not the end of stability, but the beginning of erosion, a slow unwinding of earnings that destabilizes the very foundation of demand. And once income compression becomes widespread, the slowdown transitions from hidden tension to undeniable reality. As incomes quietly contract and essential costs rise without relief, the economy enters a phase that the public rarely recognizes in real time. This is the early recession loop, the silent turning point before the data acknowledges what households have already felt for months. It begins with a subtle weakening of demand, fewer transactions, smaller baskets, postponed purchases, and declining service volume. Businesses react quickly, trimming labor costs and scaling back orders. These internal adjustments create the next wave of economic strain long before the official narrative shifts. Corporate earnings reveal the change first. Missed revenue targets spread across retail, transportation, consumer goods, and food services. Profit margins tighten as companies struggle to manage higher input costs, while customers resist further price increases. When publicly traded firms report weaker guidance, markets adjust expectations, lenders become cautious, and hiring pipelines freeze. The slowdown becomes self-reinforcing. Each financial stress triggers the next decision that restricts growth. GDP statistics rarely capture this transition immediately. Quarterly data smooths out real-time deterioration, making the economy appear steadier than it is. Meanwhile, internal corporate metrics show the opposite: declining order volumes, shrinking inventory turns, and reduced capital expenditure plans. This divergence is precisely why recessions often feel sudden, despite months of visible deterioration inside households and businesses. The early recession loop is defined by psychological shifts as much as economic ones. Consumers tighten spending instinctively when budgets become unpredictable. Companies adopt defensive posture when visibility decreases. Banks adjust credit criteria when delinquency trends steepen. These behaviors occur quietly, but together they constrict the circulation of money across the entire economy. This loop connects directly to every strain described earlier. Weaker consumption reduces business revenue. Higher essentials drain purchasing power. Disappearing savings eliminate resilience. Silent job cuts compress income. Each force reinforces the next, creating a slow-moving contraction that accelerates beneath the surface. By the time unemployment rates finally rise and the headlines declare a downturn, the underlying recession has already taken shape. The invisible phase is not invisible to those living it. It is only invisible to the metrics designed to move slowly. And once the early recession loop locks into place, the shift from subtle weakening to widespread contraction is no longer a question of if, but when. As the early recession loop tightens its grip, the impact shifts from households to the corporate layer, the point where financial strain becomes measurable, public, and impossible to disguise. Companies that once relied on steady consumer demand now face shrinking volumes and rising operating costs simultaneously. This is where the cracks turn into fractures. Retailers report negative comparable sales despite elevated ticket prices. Restaurant chains experience declining guest counts for consecutive quarters. Logistics firms face lower shipment volumes, and warehouse utilization begins to slip. These signals mark the beginning of broad corporate deterioration. Margin compression accelerates the problem. Input costs, including labor, transportation, insurance, and commodities, remain elevated while consumers push back against additional price increases. A business that once operated on a 12% margin may now be fighting to maintain 6 to 8%, a trajectory that cannot sustain high debt loads or expansion plans. Earnings calls reveal the tension. Downward revisions, reduced guidance, and warnings of softening demand become common across multiple sectors. When the financial structure weakens at the top, the ripple effect spreads downward through supply chains, vendors, and service providers. Corporate debt adds another layer of vulnerability. Nearly $1.8 trillion in corporate bonds is scheduled to mature within the next 2 years, requiring refinancing at interest rates far higher than the previous decade. Even firms with strong histories face the prospect of doubling or tripling their borrowing costs. As profitability erodes, the ability to service this debt weakens. Early-stage defaults and distressed restructurings begin to appear in industries tied closely to consumer spending. Apparel, home goods, hospitality, automotive retail, and discretionary services. These are the sectors most sensitive to weakening household demand, and they are the first to falter when revenue visibility disappears. This corporate deterioration links directly to the labor pressure already forming across the country. Companies respond to squeezed margins by reducing hours, freezing hires, and preparing for broader cuts if conditions worsen. Falling earnings signal the next stage of the downturn, providing the evidence that internal cracks are no longer contained. When household weakness evolves into corporate strain, the economy enters a phase where contraction becomes systemic. The numbers shift, the forecasts darken, and the financial system begins to absorb stress from every direction. Not gradually, but in accelerating waves. As corporate strain intensifies and consumer demand continues to erode, the next shock emerges from a place that is supposed to stabilize the economy: policy. Instead, it becomes a collision point. Households already stretched by elevated essentials now face the possibility of higher import costs, renewed tariff pressure, and policy shifts that raise the floor on pricing nationwide. When political strategy intersects with economic fragility, the result is a cost structure that families cannot absorb. New trade measures, even modest ones, ripple instantly through the supply chain. Roughly $3 trillion in imported goods flows into the U.S. economy annually, touching everything from electronics to appliances to basic household necessities. A tariff adjustment of just 5 to 10% on key categories can translate into billions in additional consumer costs. These changes hit at the worst possible moment, when real demand is weakening and nominal prices are already inflated. For households with no savings, rising costs are not an inconvenience. They are destabilizing. Monetary policy compounds the strain. Interest rates remain far above the ultra-low levels of the previous decade, pushing borrowing costs to highs not seen since the early 2000s. Mortgage rates above 6 to 7%, credit card APRs near 22 to 26%, and elevated auto loan rates restrict the very liquidity the economy depends on. Households cannot refinance, businesses cannot cheaply expand, and financial institutions price risk more aggressively. Every corner of the system becomes more expensive to operate. The Federal Reserve faces a narrowing path. Inflation remains too elevated to justify aggressive cuts, yet economic activity is too weak to tolerate prolonged tight policy. This tension leaves households stuck between two forces: persistent inflation and restrictive credit. Neither supports recovery, both delay relief. This policy collision feeds directly into the weakening corporate landscape. Higher import costs squeeze margins. Elevated interest expenses reduce profitability. Consumers retreat further as prices push beyond reach. What began as a household crisis becomes a national cost of living shock with no immediate policy remedy. The system enters a dangerous equilibrium where prices remain sticky, wages stagnate, and borrowing becomes punitive. At this point, policy no longer guides the economy. It strains against it. And when rising costs collide with a household base already running on borrowed time, the direction of the next phase is no longer uncertain. It becomes inevitable. The U.S. economy is now entering a phase where the core mechanism that keeps growth alive is losing momentum. Consumer spending is slowing in real terms. Financing costs keep rising, and businesses are adjusting to weaker demand by reducing operations instead of expanding them. The velocity of money, the measure of how actively cash circulates, is quietly slipping. An economy built on constant activity cannot maintain stability when transactions begin to thin out across retail, services, manufacturing, and credit markets. What happens next is mechanical, not theoretical. Companies seeing lower revenues cut purchasing orders, which shrinks production schedules. Manufacturers reduce output, distributors run fewer shipments, and vendors receive smaller contracts. These changes reduce work hours, cancel expansions, and freeze new hiring pipelines. Income weakens at the same time that the cost of living remains historically elevated, leaving families unable to rebuild savings or increase discretionary spending. Financial stress spreads outward as lenders reassess risk. Delinquencies in consumer credit rise, auto defaults trend upward, and revolving balances remain at the highest levels ever recorded. Banks tighten their lending standards, restricting access to capital for households and businesses. This restriction slows economic activity even further, reinforcing the downturn already in motion. Confidence breaks long before official data confirms the shift. Consumers postpone purchases, employers plan for disruption, and investors anticipate volatility. The system becomes more fragile with each quarter of reduced demand and higher borrowing costs. No sector remains insulated when the underlying engine loses power. The American economy does not collapse from the top. It collapses from the ground up. And when the consumer can no longer carry the system, the fall is not a decline, it is a rupture. The moment that foundation gives way, the crash arrives with a speed no one is prepared for.